Today we're going to talk insurance, a rather mundane topic, but certainly an important one, and I think one that a lot of boards struggle with because it's so complex, it's so dynamic, there's so many components to it. So our first video in a series of videos about insurance, we're really going to break down different coverage types, different policy types. So that's what today's video is going to talk about. So the first type of policy that an association might have is what's called a business policy. Now, carriers vary in their terms, but a business policy is a typical universal term. The business policy makes up two different components. First of all, the most important piece, the structural coverage. Whatever the association is responsible for, your governing documents tell you what the association is responsible for covering for a master insurance policy. If it's a townhome, you might be responsible for the entire structure of the building. If it's a condo, you're responsible for everything. And if it's a single family, you might not have any responsibility for coverage of the structure. Maybe you've got other things like maybe a monument in a common area that you're covering. So that's the first most important thing of the business policy. The second part of a business policy covers liability. It's the general liability of the association for if there were ever a lawsuit against the association to protect it from that. So we're going to break down specifically the different types of coverage within the structural coverage. There's really four types of coverage, and again, these terms might vary by carrier, but these are somewhat universal terms. So the first would be bare walls. So this is just that. So if you're in a townhome association, for example, that has a bare walls policy, if there were ever a loss that exceeded the association's deductible and the association filed a claim, and if there were damages inside of the unit, it wouldn't be covered. It would cover the sheetrock, it would cover the exterior siding, it would cover the roof, right? But really very limited, if none at all, inside of the unit, bare walls coverage. The second type that is a little more common would be original construction. So if you had a townhome association, again using that example, that was built in the 80s, for example, if you had a water leak that maybe went into the kitchen, and again the claim exceeded the association's deductible, and there was a claim filed on the association's policy, that water damage would really only replace what might have been original construction, such as in the 80s, laminate countertops might have been really common, and vinyl flooring might have been common. Well, today you probably got maybe a granite countertop and maybe some sort of wood flooring. So if there were a claim under original specs, you're only going to get paid out for what was originally constructed, laminate countertops and vinyl plank flooring, and then you would have to make up the difference. The next would be a modified, what's called modified specs. So this might cover some components. Maybe it covers sheetrock and flooring, but not cabinets, for example, or light fixtures, for example, right? So this one really varies, and the governing documents would have to dictate. The last, final, and probably the most common type of policy for condos and townhomes would be what's called an all-in policy. So regardless of when it was built, regardless of what the materials are, everything is covered. So a good example is you take a home and you tip it upside down, and whatever doesn't fall out is covered. So if you had a water loss, let's say it's in a condo building that starts on the top floor, because all leaks start on the top floor, right, naturally. So everything affected the units below, they have to redo their kitchens or their bathrooms. They're going to pay out whatever was built today. So that's all in policy. So again, the structural coverage as a part of the business package, the business policy, those are the four different types of coverages that might be included with that. So the next piece to your business policy is the general liability component. Typically this is 1 to 2 million, or sometimes 2 to 4 million. 1 million per incident, 2 million in aggregate total, or 2 and 4. 1 and 2 or 2 and 4. So this covers the association if there were ever a lawsuit, right? And one misnomer about lawsuits is that this doesn't cover homeowners suing the association. That's a different policy, which we'll talk about in a minute. This really covers guests or vendors or people walking through the association. Someone slips and falls would probably be the most common type of, in Minnesota, certainly the most common type of lawsuit against the association. A judge would always say that it doesn't cover the homeowners because a homeowner can't sue themselves, right? They're a member of the association, they can't sue themselves. So the general liability is a part of your business policy. So now let's move on to other coverage types of your insurance policies, which would be considered ancillary policies. So the first would be the directors and officers coverage. So this is liability against directors and officers. This would cover the association if a homeowner wanted to sue. So this covers directors and officers coverage, covers what's considered wrongful acts. If the board acted incorrectly, if there was money stolen, if they didn't follow procedure or governance accordingly and it adversely affected a homeowner, the board is open to be liable for a lawsuit. And the directors and officers coverage would cover that. Typically this is a $1 or $2 million policy. The next is crime and fidelity coverage. So this is another ancillary policy. Crime and fidelity is very simple. It just covers the assets, the physical monetary assets of the association. So add up what's in your checking account, look at what's in your reserve account. If it's $300,000, you better have at least $300,000 in crime and fidelity coverage. Covers your cash, money, your assets. The next is an umbrella policy. Now, an umbrella policy, not every association has them, maybe half, maybe 3/4 will have them. An umbrella just covers gaps. If a homeowner sued the association, the directors and officers policy for $2 million, but you only had $1 million in coverage, if you had $1 million umbrella, it bridges the gap. Another example would be the general liability. So I mentioned if you might have had a $1 million per incident, $2 million total aggregate. So let's say you had 3 claims of $1 million. Well, that's $3 million. So if you had $1 million umbrella, again, bridges the gap. The last policy that an association has is workers' comp. And now this is one that a lot of people ask, why does an association have a workers' comp policy when we don't have employees? Fair enough question. Workers' comp policy covers 2 components. First of all, it covers volunteers of the association. So it covers you as a board, or it covers maybe a committee member. If they were to get hurt doing official association business, maybe Sally is running to go get cookies to bring to the annual meeting. Well, Sally is acting on behalf of the association, and if she gets into an accident on the way back, she would have coverage via the workers' comp policy. So the other thing that it covers, or maybe even more importantly, is it covers lapses in insurance for association contractors. So if the lawn and snow vendor of the association, if their worker comp policy were to expire, unbeknownst to them, and one of their workers were to get hurt, and all of a sudden that worker couldn't be covered under the company, well, guess what? The association is next in line. He can come after the association for coverage, and in which case, if you have a worker comp policy, you're covered. So it's a worthwhile policy to have. So finally, what is not an association policy, but I do want to just touch on, is a coverage is HO6 policy. Now this is what a homeowner carries in the association, right? So we're going to cover this in much greater detail in other videos. But an HO6 policy essentially covers the personal contents of that homeowner's. So again, you take a unit, you flip it upside down, whatever falls out, those are their personal contents. The association policy wouldn't cover it, but theirs would. It also covers structural coverage if the loss doesn't reach the association's deductible. So if they have a $5,000 water loss, the association deductible is $10,000, well, it's the HO6 policy that pays it out for the homeowner. So that concludes our talk about insurance today. We've got a series of videos on insurance about these specific policies and much more. We welcome you to go and find them at sharpermanagement.com in our educational video library, and hopefully you found this video helpful.